Hi, my name is Josh Swanson. Today I'm going to be talking about the Other Comprehensive Basis of Accounting, otherwise known as OCBOA. First, what is OCBOA? So OCBOA differs from GAAP. So as you know, any public company uses GAAP and is required to use GAAP when creating their financial statements, and GAAP gets their principles from FASB or FASB. Since OCBOA does not fall under GAAP, it is not required, therefore, to use the principles brought up in FASB. Um, some of the inclusions of GAAP or of OCBOA are, you can either have your cash basis of accounting, your income tax basis of accounting, your modified tax basis of accounting, and your contractual tax basis of accounting. But most times, you'll see companies who do end up using the OCBOA will use the tax or cash. And also, a lot of companies that use the OCBOA are insurance companies, and that is because OCBOA allows them to hit their targets and regulations along with the state insurance commissions. So why are the OCBOA standards important? Well, number one, it's a lot less expensive. So companies that do, and I will go into what type of companies and what type of businesses would choose the OCBOA and why they choose it, but it's a lot less expensive because there's so much less, that you have to do to, um, uh, align with the OBCOA standards, and because of that, it's also a lot easier to read and analyze. So you don't have to be, a CPA to necessarily understand what OBCOA is trying to, the financial statements of a business are trying to tell you, versus GAAP, because things are just a lot less complex, which I'll talk a little bit more in a couple slides here. So what is FRF for SMEs? Why did it come about, and why is it important when we're talking about OBCOA? So FRF stands for Financial Reporting Framework. SME is small and medium-sized entities. So it's basically financial reporting framework for small and medium-sized entities. This is important because a lot of small entities aren't public, and a lot of small entities have no desire to be public. Therefore, they don't have to choose to align with GAAP. OBCOA allows them to do otherwise. So FRF removes the complexity. Like I said, one of the nice things about OBCOA is it removes the complexity of GAAP. So an example of that is it uses the historical costs as a measurement basis. So, with GAAP, you don't always use the historical costs. There's sometimes historical costs, sometimes not. When we're looking at depreciation, it can be different. There's straight line, there's double weighted, and things like that. Another great example is no complicated fair value measurements. In a lot of GAAP valuations, there are certain things that are book value, certain things that are carrying value, which is similar to book value, and then certain things that are fair value. When it comes to auditing, there are a lot of things that need to be measured at fair value and also displayed on the financial statements at fair value. But with OBCOA, and it's a lot less complex in those terms. Another great thing, and to be honest, probably why the FRF and the OBCOA were created was it allows the users to have more control. So like I said, these are smaller businesses that aren't necessarily, they don't want to be public, and they are small, and they don't need to, do all the things that GAAP requires. So the nice thing about it is it's intended for the most appropriate use based on the user. So whatever the user needs, OBCOA allows that. Another thing is, it's like I said, it's created for SMEs that aren't required for GAAP. They just don't have to align with it. So why and who is it important to? Well, it helps out businesses that don't plan on going public, like I said, and a couple other very important things is it, uh, you know, a business that wants to assess performance based on what they own and they owe. OBCOA perfectly allows for that. Like I said, it's a lot less complex, so it just more simply shows you here's what you own, here's what you owe. It doesn't have to go into as deep of financial statements. Like I said, one of the things um, that you don't need in OBCOA is a statement of cash flows. So that's kind of just an example. Um, Another thing is bankers. A lot of times when companies try to get loans from a bank or trying to make decisions with banks, banks say, okay, send over your financial statements. Um, and they'll make decisions on your EBITDA, and they'll look at your financial statements and look at, well, what are the likely chances that we get our money back? What are the likely chances that you are going to be successful with this money? So OBCOA is perfect because it gives the banker, because bankers don't always make their decisions just simply on financial statements. So bankers that make decisions based on more than just financial statements, in OBCOA, it's perfect for companies. For companies, it's perfect for these situations. So what are some differences from GAAP? I've already gone through this a little bit throughout my presentation, but just to recap and kind of summarize, it's much less complex, much cheaper to prepare. Like I said, you don't have to use historical costs for everything, or I'm sorry, you do use historical costs as everything, and you don't have any complicated fair value measurements. Um, OCBOA does not require a statement of cash flows, um, and it's based off the needs of the user. One of the uh, one of the disadvantages or critiques of OCBOA is the disclosures. Oftentimes, disclosures are often criticized for their adequacy, um, but a key note. OCBOA, when you are using that framework and you are creating the disclosure, your disclosure must align with GAAP, just from a comparability standpoint. Because, um, and I'll go into that in a little bit. But does that change a lot for the OCBOA user? Not necessarily, because they still have important professional standards. They still can get audited. You can still audit OCBOA financial statements. You can still review those financials. As I said before, bases must be disclosed and disclosures must be comparable to those of GAAP. Those are very important things. And you can't make a modification that's so extensive that it results in a GAAP basis statement with departures. So like I said before, comparability. Does this affect comparability? If you were to take a public company and try to compare with a private company, and you're interlinking GAAP and OCBOA, does that affect comparability? Well, yes, because number one, there's a difference of statements. Like I said before, you're not going to get a statement of cash flows if you're comparing a company that uses OCBOA. Number two is your difference of valuation regarding assets. Like we mentioned before, there's different valuations. So a company that uses GAAP is going to have different different costs or different numbers in their income statement regarding depreciation, different numbers in their balance sheet regarding depreciation than a company that uses OCBOA. So, and even their property, plant, and equipment are going to look a lot different because you might not have as complicated a fair value adjustments and equations. So it does affect your comparability, but that's why they make an emphasis that your disclosures are an important matter because those must align with GAAP. So why do we need to know this? Not every company uses GAAP, and that's important because not every company needs to. Small businesses make up over 90% of the businesses in America, but not all of them are ever going to be big enough or be complex enough to align with GAAP where it just isn't necessary for them. So, and it's also important because as an auditor, as a CPA, you could come across one of these companies if you work as a auditor for a regional firm, and you come across one of these smaller companies. You need to know how to handle a company that uses the OCBOA framework, and that maybe using the cash basis of accounting or the tax basis accounting. Here are my references. Thank you so much for listening. I hope I have a great day.